Hey guys, Eric here, Mr. Fired Up Wealth. Hope you're doing great. Last time we brought you the top 10 DGI stocks, dividend growth stocks, DGIF stocks in the finance sector. Today, I'm excited to announce we're going to do the top 10 in the healthcare sector. Now, I spent a lot of time on this video, and actually I couldn't get it narrowed down to 10. So I have 10 picks, and then I have 10 bonus picks. And the reason for that is a lot of the really good picks that I thought were that I own in my portfolio that I think have great growth potential don't necessarily fit all of the 5 parameters for DGIF. Now, if you're not familiar with DGIF, I encourage you to go watch the videos before this. There's an intro video, as well as I just mentioned the top 10 financial sector DGIF video. So today is video 2 out of a series of 6 total videos, 7 with the intro. So after today, there's still going to be 4 more videos, which of course is 40 more picks. So if you haven't subscribed, please do that now by clicking the little red button on the bottom right-hand corner. And there's a little bell you need to click to get notifications. Now, just a quick recap on DGIF. What is that? Dividend growth investing for fired. And what that really just means is that we want to focus on total growth, on growth of the stock itself, as well as growth of the dividend. So there's 5 criteria that I look for, and I'll cover those real quick before I get into my picks for the healthcare sector. The first thing is I want a dividend that it's 3% or less usually, and not always. And there's actually a couple picks in today's video that are going to be above that 3%, but there's also a handful that are really low dividend. The reason I typically like 3% or less is because I want the stock to grow. And typically if the stock has a higher dividend yield, it doesn't grow, doesn't either pace or outpace the S&P 500. The second thing is you want to have a dividend payout ratio of 50% or less for similar reasons. You want to have 5-year dividend growth. So you want to have 5 consecutive years of dividend growth. Out of that 5 years of dividend growth, you want at least 10% growth in that 5-year period. And then the fifth thing is I'm looking for a 10-year annualized return of at least 10%. So those are the 5 criteria that we're looking for. Again, I've got 10 picks coming up and then 10 bonus picks. So please do stay tuned. It's going to be really good. There's several mega caps, but I also have some small and some micro caps that you've never heard of. In fact, I spent a lot of time researching this video, and a couple of these I never knew about and actually have bought in my own portfolio now. So you're going to want to see these picks. Without further ado, let's get started. Okay, guys, number 1, let's just get this one out of the way because it's a beast. It's the best one out of the whole group. Now, these aren't in any particular order when I do these lists, but this is the best stock out of the 20 I'm going to talk about today. Out of the top 10 that I'm going to go through first before the bonus picks, there's 6 mega caps, there's 2 large caps, there's 1 small cap, and a micro cap. And there's a really good growth of mix and dividend yield with all these picks in this video. So I think there'll be at least a few ideas. You know, no matter who you are, you're going to have a few ideas in here in the healthcare sector that you might like, that you'll want to explore for your portfolio. But United Healthcare, UNH is the ticker. They crush it. In fact, it's a mega cap, and it has the best dividend growth, and it has the best 10-year annualized return out of the entire group, out of all 20 stocks that I'm going to talk about today, which is pretty impressive when you think about the size of it. It's just really a high-quality company. It has a great balance sheet, has great leadership. Let's just take a quick look at this Fidelity screen. You can see it's down 1.75% today, but that's because yesterday it was up over 5%, had a big bounce. Recent earnings, and then of course, some political reasons, right? We won't get into the politics, but so it is down a little bit today. It's the 52-week high is $302.54 back January 21st. So that was when we had our big run up, probably before the coronavirus scare, if I were to look into that. It's a high quality company. You can see earnings per share has beat, 15 cents, 13 cents, 13 cents the last 3 quarters. This fundamental analysis is not always right. It's not, don't go buy stocks off this, but I will tell you that on Fidelity, if you look at this fundamental analysis, it usually gives you a pretty good gauge of a stock. If all those are down in the red, it's usually a stock that's not going to perform well, or it's some kind of crazy high flyer. When you're looking at a dividend growth stock and it has, really high marks like 89 on valuation, they're trying to say it's undervalued here, guys. That it's high quality, it has pretty solid growth stability and really good financial health. The balance sheet is phenomenal. This is a Q&A from a recent conference that they did. And I'm not going to read all this, but one thing I did notice right away was United Health Group is comprised of 325,000 men and women. That's a lot of employees. I didn't realize that. I've been in business 20 years. It talks about long-term outlook for financial performance. We anticipate continued growth of our healthcare enterprise as a result of delivering differentiated value to our customers, consumers, and society as a whole. Our long-term outlook for earnings per share growth remains consistent at 13 to 16% annually on average, with about 2/3, 8% to 11% of this growth driven by earnings from operations, and 1/3, 3 to 5%, from capital deployment. What I want you to focus on there is that you've got a company that's willing to tell you numbers and put it on a sheet and put it on their website. Usually, obviously, it's never a guarantee that they're going to perform that, but they have a track record of doing so, and they're telling you that they're going to have earnings per share growth between 13 and 16% a year on average. So this, to me, it's one of the safer picks that you possibly can get. It performs well. It pays a solid dividend, everything that you want out of a DGIF stock. So there was a question that says, what is the balance between future dividend policy and share repurchase policy? And of course, repurchasing of shares has been really big in the last few years. And it's controversial, but as a shareholder, it decreases the number of shares outstanding, which in theory increases the value of what you own. So shareholders, like that. It's not always the best use of capital for companies. It just depends on the situation, but it can impact the share price. And if you're a shareholder, a lot of times it is helpful. So it says that we regularly consider the balance of allocating the capital of our strong cash flow provides among key several priorities, ensuring capital strength of regulated entities over the overall enterprise capital structure, internal reinvestment opportunities, further growth through acquisitions, and returning capital to shareholders through dividends and share repurchases. And there's a whole bunch more information below that. But what I want you to focus on is they're telling you they're going to have excellent, very good earnings per share growth that we discovered a second ago, and that they're going to continue to take the dividends and share buybacks seriously. So this is good news as a shareholder. We like to see stuff like this. It gives you confidence, that you're investing in something that's going to give you a return on investment. That's what it's all about, right? This is from their, United Group presentation. It's from their last earnings presentation, and it shows the 2020 growth performance by platform. And so this is, United Healthcare. They have United Healthcare. They have Optum. If you're familiar with Optum, they do, for example, HSAs. So if you have a health savings account, Optum runs those. It was an acquisition they did, and it's growing pretty well, as you can see. And then there's United Health Group. So there's really 3 different segments of their business. You can see the revenues for United Healthcare between 7 and 8%, earnings between 9 and 13%. Optum has got the best revenue and earnings growth at 13 to 14 and then 13 to 16%. And United Health Group, 7 to 8% and on the revenues, and then earnings 12 to 14% is what they're telling you. So good information there. And there's a ton more information on here if you want to look at, the adjusted earnings per share and all that fun stuff if you're into finances like I am. I can nerd out all day on that stuff, but we've got more stocks to cover. So this is a Seeking Alpha article, and I know a lot of DGI investors really like Seeking Alpha, and so I wanted to incorporate them today. This is written by Chris Lau, Lau, and he's got do-it-yourself value investing. So I like to hear that, right? Value investing, all right? So he's saying, and this is why I wanted to read this. So balance sheet and valuation analysis. So UNH has a return on equity of 26%, a debt to capital ratio of 40%, and recently increased its dividend by 20%. Though the dividend yield is only 1.59% compared to, say, 3.6% with Walgreens or just under 3% with CVS Health, investors are rewarded by their stock price increasing, which is what DGIF is all about. I want to focus on the stock price increasing more than anything, and I want to get some, it's like having my cake and eat it too. Being able to get the icing on the top is the dividend, to buy even more shares of something that's growing. It's great. And it says here, with an operating cost ratio of 14.5%, a 50 basis point improvement, investors may build a financial model that includes a drop in costs annually. Okay. Computed using a discounted flash flow analysis, UNH stock has a fair value of $396. Didn't we just cover this? It was $290. So this guy is saying that it's got $100, $106 of room to grow. It has a safety margin of 45%, and the value score is a 97, growth score 95, and quality score 86. So that's pretty close to in line what we saw in the fundamental analysis on Fidelity when we went over and we looked down here, right? So you can see the valuation 89, quality 88, growth stability 67, financial health 97. Here he's saying value score 97, growth score 95, quality score 86. Compared to its peers, United Health Group is the top of the value score list. So not only does it perform, it's also a good value play right here. Well, I mean, what am I missing? Is this too good to be true? I don't know. But following Cigna, I know, Mark, you'll like that one. And then I'm bullish on Cigna and recommend CVS for DGIF. So there you go. Price target takeaway. 20 analysts who cover United Healthcare stock have a price target of $327. Now that's only $37 more than what it's trading at today. Take a look at United Healthcare, stock ticker UNH for your portfolio. Okay, guys, moving right along to number 2, we've got Medtronic, stock ticker MDT. It's really a great fit. You can see some of the stats here, 1.79% yield, 52-week performance is 37%. It's a dividend aristocrat. It has actually 42 years of dividend growth, and it has a payout ratio of under 40%, which we like. And for me, I mostly like this as a future play to compete with Intuitive Surgical as a robotic surgery play. So I'm not sure if you're familiar with this, but they have a product called Hugo due to a recent acquisition, I think from about a year ago, 2018, I believe. And Medtronic, one of the world's largest makers of medical devices, is an income machine. The company's dividend per share increased around 75% over the past 5 years, and they aim to return at least 50% of their free cash flow to shareholders through dividends and stock buybacks. Medtronic holds more than 4,000 patents on products ranging from all kinds of stuff, heart replacement valves, surgical stapling devices. Whether you're in the United States or 160 countries or so, if you take a look around any major hospital or doctor's office, the chances are you'll probably see a Medtronic product. They're very big. They've been around for a long time. And I'm not going to spend a whole lot of time on it because we've got a lot of picks to cover. But Medtronic is solid. You can see the earnings per share is beat 7 cents, 8 cents, and 3 cents the last 3 quarters. The fundamental analysis here, looks very strong. I've done a lot of homework on this. I've spent a lot of time breaking down financials, looking at their growth models and trends. Obviously, the P ratio on this one's a little higher at 35. But if you look at the way it's performed and the potential for growth with Hugo is, again, why I really like this one. Take a look for yourself. Stock ticker MDT for Medtronic. All right, guys. So the third one on the list that I want to cover is US Physical Therapy, Inc. Stock ticker is USPH. And before we jump into this, I want to just announce that if you say you've watched the other video and you're saying to yourself, why isn't he showing me all the stats like he did last time? The reason for it, I want to do rapid fire here. When I get done with the 10 picks, I'm going to compare all of them on one screen. And if I do that now, you're going to know all the picks. So I want you to watch and to hear what I have to say on each of these. And then when I get done with the 10 picks, there's going to be a screen share. It's going to show you all 10 of them and compare all the numbers against each other on the 10 picks. After that, then we're going to get into 10 bonus picks. So hang with me. I appreciate you sticking around and watching this far. We've got a lot to cover, so let's keep going. So this one here is a small cap, and you can see it's a $1.54 billion small cap. A little bit of a volatility there. Check out that chart. It was $102.92 back in March of last year, and had a 52-week high of $148 here, November 5th of 2019. It's only up 10%, 10.88% on a 52-week. It only pays a 1% yield. And you're saying, why in the heck is this even on here? The reason is because if you look at the 5-year growth of the dividend, and more importantly, the 10-year, if you look at the 10-year, it was one of the top performers for the 10-year annualized. And it's one that I do like for growth potential. You can see that these guys beat and then met for earnings per share. You can also see that These look pretty stable. The growth stability is a little bit low as a 53 on the fundamental analysis. And it shows the long-term sentiment, 9 months to 2 years, actually shows weak, which I think is interesting. This one is a little bit of a higher risk pick. But the reason that I like it is if you look at, it talks about the growth is the reason I like it. But in terms of the company profile, it's something a little bit different. This is a healthcare providers and services industry. So it's within the healthcare sector. And then the subcategory, the sub-industry is the healthcare providers and services. And through its subsidiaries, it operates patient physical therapy clinics and provides pre and post operative care and orthopedic disorders. So when you think of sports-related injuries, preventative care, rehabilitation of injured workers, neurological injuries, the company provides industrial injury prevention services, including on-site injury prevention and rehab, performance optimizations, and ergo assessments through physical therapists and specialized clients. It looks like for Fortune 500 companies and other clients comprising insurers, et cetera, et cetera. Operated 592 outpatient physical therapy clinics in 42 states and managed 28 therapy facilities. It was founded in 1990. It's based in Houston, Texas. And I do want to go to their website really fast. So this is, again, US Physical Therapy, Inc. And you can see they have some strategic partnerships, investor relations, press releases, contact, and so on. But I wanted to go to the about here and just show you. You can see that they're all over the place. I mean, let me zoom this in. So here's a United States map, 41 states here, it says. They're pretty much everywhere except for, a handful of states here throughout. But all through the Midwest, for the most part, both the coasts have pretty good coverage. So, 560 clinics in 41 states. It's the largest publicly traded pure play operator of outpatient physical and occupational therapy. This is something to me that is recession proof. If you blow out your knee, you're going to get it fixed and you're going to need to rehab it, whether, the stock market's a bull or a bear, so I try to think about it that way. The fact that it's done really well in a bull market, but to me, it's one of those stocks that, they should still perform well. It's one of those people are still going to spend money, doing this. You're not just going to blow out your knee and say, well, it's a bear market and I can't afford it. So I'm just going to, have my ACL torn for 3 years. I mean, I'm being facetious, but you know what I mean? So I like this one kind of as a hedge play a little bit when you think of risk reward in the different markets. This is one I think that will still perform pretty well regardless of the situation. And you'll see it towards the end of the top 10 list, why I like it in terms of the performance, the growth. It's actually kind of crushed it. If you go back to the stock here on Fidelity and go to, let's just do a max chart once. You can see this big drop here, but look at that chart. It sat here for a long time. So here's 2008, and you can see it obviously went from $13 and it dipped down here to 10, went down to 7. So, I mean, it had a dip like everything, but it recovered a lot faster. Everybody kind of panic sold everything, just flush everything down the drain. But you can see, if you compare this to other charts in this same time period, they started to rebound much faster and they continued upwards even when, this is just a straight line up and we're starting to see some resistance. This is a huge kind of correction recently. It's got a 51 PE ratio, so it's not cheap by any means, but I do see this one long term. If you hold it for 10 years, I think it's one that's going to be around for a while. They're going to keep growing that dividend, and it's going to be one that will perform well for you. Number 4 on this list today is AMGN. It's a biotech. It has a great dividend yield of 2.76%. It has a PE ratio of about 18. Excellent dividend growth, especially considered it has a 17% 10-year annualized return, so it's performed very well over a 10-year period. 5-year dividend growth is 21.27%. And again, I'm going to show you all these and compare them in one screenshot later so you can see. But this has a very solid track record. You can see it's crushed its earnings per share, 38 cents, 13 and 17. It's performed pretty well. High quality, fairly stable growth. Right now, it looks like it might be kind of hitting some resistance. Had a little nice dip here, and it's kind of heading back up. It's at $231.50 $1.45. But it's a good company. I wanted to look at the pipeline really fast. This is important. Anytime the biotech guys, I mean, I'll say this, biotech, they can be high risk. The ones that I buy are typically ones like this, where they're very established, have a solid yield. If you're buying a biotech that doesn't have a dividend, yield, it's, it could be a multi-bagger, or, you could lose a lot of money on them. So be careful with that. I mean, if you're really interested in biotech, there is an ETF. There's a couple of them. I like IBB. There's other ones out there, but IBB is one that has some biotech, and it's a little bit more conservative than some of the other ones. But let's go to their pipeline, and you can see that they've got AMGN. Here's kind of what's going on with their pipeline. So phase 1, they've got quite a few drugs. Phase 2, they've got a handful, and then phase 3, they've got all these. So if you don't understand what all this means in terms of biotech and pipeline, I encourage you to do a little homework. And if you completely don't understand, how there's a lot of risk and reward when it comes to pipeline, and that's really what makes or breaks anything in pharmaceuticals or biotech, because they have a drug that only lasts so long, and at a certain point, it no longer has status. It goes to generic status, and people can compete and take. AbbVie is going through something like that right now. But yeah, I mean, in terms of biotech and pharmaceuticals, their cycles, their pipelines are very important. So it's important to understand that. These guys do have a solid pipeline from what I can tell. And I've spent probably 2 hours going through everything and kind of reading threats. I like this one. It's one of the better performers. Is it one of the safest stocks on the list? Probably not, actually. It's going to have a little bit higher risk and a little bit higher reward. So if that's your risk tolerance, take a look at AMGN, stock ticker AMGN. All right. Well, speaking of risks, all the stocks in here are going to have some risk because of government regulation, and there's always going to be that threat, which is part of the reason why the healthcare sector has been kind of beat down recently. But Anthem, stock ticker ANTM, is number 5 on my list. It's managed healthcare. Obviously, that's part of the reason why it hasn't performed well. It's actually red over 52-week. It's down 5.34%. It pays a 1.32% yield, has about a 15.5 P ratio. The U.S. government proposes higher payments to Medicare insurers in 2021. There are some threats here, of course. They basically have 3 segments: commercial and specialty business, government business, and other. And if you go to their website, this is just their website. I've got it zoomed in a little bit. Let me zoom it in. Leading benefits company dedicated to improving lives in communities, making healthcare simpler. Through its affiliated companies, Anthem serves more than 79 million people, including 41 million within its family of health plans. We aim to be the most innovative, valuable, and inclusive partner. For more information, go to Twitter. 1 in 8 Americans receives coverage for their medical care through Anthem's affiliated plans. We offer a broad range of medical and specialty products. In my opinion, it's undervalued. In my opinion, they're not going anywhere. There are threats there. It's going to be a stock that, will kind of have ups and downs, but if you're holding it long term, you can see what it's done. Look at this chart. So from 2010 to up here, I mean, it's just had a wild ride like a lot of stocks. But the reason that this has to be on the list is because it has solid dividend growth. It has a very solid 10-year annualized performance, one of the best on the list. And to me, I'm always looking for value. I'm looking for deals. One of the picks that we're going to get to later is Cardinal Health. And I was buying that in 2019, and it's up 35%. It just popped after earnings, and it's up 12% today. And I'm up 35% in less than a year, and my cost basis yield on it's 4.5%. So obviously I'm not going to get 4.5% with Anthem, but I feel like this is one where if you hold on to it long term and they keep growing the dividend at the clip they are, look at the fundamental analysis. I mean, really high quality, high growth stability. I think it's just one that, that could take off at some point. Again, I have to reiterate that, most of these stocks are going to have some risk. There's unknowns politically. There just are. There's always going to be risks in the healthcare sector and in any sector for that matter. But that's one that you have to look at. It's a large cap. So this isn't a mega cap. It's one of the large caps. It's at $72.92 billion. But do take a look at Anthem. I want you to do your homework on this if it's something that interests you. The stock ticker is ANTM. Number 6 on the list, it's one of my favorites. It's actually one of my top holdings. I own probably more of this than I actually should, to be honest with you. But it still pays a 5.45% dividend yield, and I bought it when it was way lower. You see this chart? This is, it was $65. This is when I was buying it heavily in the 60s. It's now at 87.12, and it has a 52-week range of 91. But if you look further out on this chart, and there's some history to this, and I'll get to it, but this thing was way up here at $120 at one point, and it's kind of come down. And there's a lot of you either hate this stock or you love this stock, and there's nothing really in between on this. It feels like anyway. More and more people are starting to like it because they're starting to figure it out, I think. When you look at Bristol Myers, when they bought Celgene, that was embraced right away. This one, with AbbVie, when they made their recent acquisition, it was not well received, and it's just one that most people didn't embrace it right away, and this is why it just got punished. Paid too much, whatever. So if you look at this though, they've beat by 9 cents, 5 cents, 3 cents, and we actually have an earnings tomorrow. So this is great because the video is going to release Saturday. Today is Thursday. There's going to be earnings tomorrow. It's $87. So this thing's either going to be down like 5% and it'd be maybe a good buying. Well, I know it's a good buy. Personally, for me, it's a good buying opportunity if it did drop below here. Or, it's going to be one of those things where they crush their numbers and this thing's up and you're going to miss the boat. Because if it's at $95 or something, I might not be loading it up, backing up the truck, So the growth stability on here, they have it at 7, right? And the thing about this is that it doesn't fit all the parameters of DGIF because of the high yield. I usually want 3% or less. This thing, is 5.5%. Mine's in the 6s, I think, on my cost basis. But it has 47 consecutive years of growth, asterisks, and I'll get to what I mean on that later because there's a drop story behind that. You can see the chart. It all goes back to 2013. There's a reason. You might already know the answer, but I'm going to cover it later. They have the max payout ratio is 50% that we want for GGIF. These guys are 49.95%. So the yield is high, but the payout ratio actually works. And, I'm going to read this real quick. AbbVie's dividend yield of over 5.8% ranks as one of the highest among healthcare stocks. Even better, the drug maker has increased its dividend by 168% since it was spun off from Abbott Labs in 2013. Well, I'm covering it now. I'll cover it later too, so stay tuned. The primary concern that some investors have with AbbVie is that the company is highly dependent on the sales of Humira, which now faces competition in Europe and will do so in the bigger U.S. market beginning in 2023. So in 2023, we'll have generics. AbbVie has been planning for this scenario for years and should be in a position to keep the dividends flowing while delivering moderate growth. In 2019, the company announced a $63 billion deal to buy Dublin-based Allergan. That's the merger I was talking about earlier that wasn't well embraced by Wall Street at first. It's famous for Botox, and $63 billion is a lot of money, and that's people freaked out. That's why the stock dropped. So Allergan is famous for Botox, but also they have eye drops, some irritable bowel syndrome treatment, fat freezing technology called cool sculpting, which I'd never heard of. In addition, they have other things going on for them in their pipeline. At the recent JP Morgan healthcare conference just here last month, AbbVie CEO Richard Gonzalez said that they have a couple of drugs. It's Rinvoq and Skyrizi, and I'm probably saying it wrong, guys. I'm sorry. I'll put them up on the screen. Those two names together could conceivably reach peak combined sales of $20 billion, which would approximately match Humira's global peak. So that's really good, right? So I like this company. it has some risk to it, but with the yield and with what they have in their pipeline, I think it's a great one to have. It doesn't fit my typical, structure of the five, the five categories I'm looking for, but everything about it is good except the yield's too high. And I think that I bought it down in the 60s. So that's the thing, right? It's at 87 now. So maybe the story is different for you, but for me personally, when I was buying in the 60s, I didn't really see a ton of risk in that price range. And it's panned out really well for me because now I've got a great position that, it's nice and green. It's up big from where I bought it, and I'm still collecting a 6% or whatever yield on it. So I love picks like that. I absolutely love them. I've made a career out of picks like that. And I still think there's a lot of upside to this stock, but I want you to do your homework, make sure you're comfortable with what the risks are. I've kind of talked through some of those risks here. But ABBV is the stock. Stock ticker is ABBV. All right, guys. So number 7, I almost said 6. Number 7 is stock ticker LMAT, and this is pronounced LMAT. And forgive my poor accent. It is headquartered in Burlington, Massachusetts. It's a micro cap. You can see here it's $737.07 million. And it only has 4 years of dividend growth. So it does not fit the minimum of 5-year growth. It also has a really low dividend yield of only 0.93%. And it is kind of expensive at 38.57. But I actually am buying a little bit of this in my spec bucket. I'm not loading up on it or anything. It's up 51.47% on a 52-week. And I actually really like this one as kind of a hyper growth dividend player. So this would be like a potential what NVIDIA is, because NVIDIA is DGI. It just doesn't pay a very good dividend. This is comparable to that and pays actually a little bit more yield than even NVIDIA does. But this is the NVIDIA of healthcare is what we'll call it. And it's not going to grow like NVIDIA, but hey, 51%, 52-week performance, what's going on here? So these guys do medical devices. It's healthcare equipment and supplies industry under the healthcare sector. And they're, again, in Burlington, Massachusetts. And they design, market, sell services that support medical devices and implants for the treatment of basically it's vascular diseases. So you think of blood vessels, heart issues, blood clots, things like that, blood flow issues. But, as our population ages, I see a huge demand for this, and there's so much growth potential here. They haven't been around, forever. They're a micro cap. It says here that the stock started in 2007, but it literally did nothing from 2007 to 2014. It sat there, and then it went all the way up here. It nosedive, and it's kind of working its way back up. So this one's going to have risks, like a lot of them on this video are, but at the same time, this is one that could give you some tremendous returns. Is it going to give you 51.47% again every year? Probably not. But you can see where it dipped down and it's starting to make a comeback. In terms of the earnings per share, 23 cents beat by 2, 25 cents beat by 4. I listened to an actual earnings call last night. It was kind of painful, actually. It is, sometimes, I don't know, sometimes I'm not in the mood to listen to those and they bore me to death. But I listened to it. I read through all the financial reports, everything. It's basically just it's kind of a high flyer DGIF stock is what I would call it, guys. It has, some risk to it. It's expensive, but it has a lot of upside reward. So do your own homework on this one as well. And, take a look at it. They pronounce it LMAT. I'm guessing it's French, and I apologize that I don't know French. The stock ticker is LMAT. Okay, guys, number 8 is Eli Lilly and Company, stock ticker LLY. And this is an interesting one too. You can see here's the stock chart from 2011 to now, and you can see it had a little dip, kind of like the last one we just looked at, and then it's kind of this almost like a parabolic movement upwards. I hate to use that word, but man, that's straight up. There's some risk there, but at the same time, it's only up 22.35% on the 52-week. The PE ratio is 29.35, so it is expensive, but not unreasonable. The PEG ratio is 2.68. The yield is 2%. It's done well. It's acting very bullish. The earnings per share, it's beat 5 cents, 7 cents, and 21 cents. Everything looks good on it other than the growth stability might be a little bit lower. It is a pharmaceutical company, so it's in the pharmaceuticals industry within the healthcare sector, located in Indianapolis. And they do a lot of animal health and then human pharmaceutical products. So they have the two different segments. They have human pharmaceutical products and then animal health products. So they do things with diabetes, and you can take a look at their website if you're interested in all the different things they do. But the numbers are really good, except the dividend growth. So the dividend growth on this, on the 5-year, actually was a little lower than I want. I like 10% minimum, and they were at 8.59. But I think part of the reason is that they've done so well on the 10-year annualized. Their 10-year annualized return is a 19%. It's over 19% over a 10-year period annualized return, with that 2% yield. It's a mega cap. So, excellent growth, and that can't be ignored. I had to include it on here just because it's really close to the 10% mark, and it kind of crushes everything else. Will it continue to perform this way? Not for sure, but I dug into this one as well, and I don't see a whole lot of issues other than maybe pipeline. So there are some risks there, and that's, like I mentioned earlier, anything biotech or pharmaceutical, there's always going to be, there's going to be risks not only from government regulation type risks, but pipeline risk, because at a certain point, every drug will go generic and people can copy it. And you've got to constantly have a pipeline of new drugs that's coming out all the time, which is why the M&A space, there's so many mergers and acquisitions, because, BMY, Bristol Myers, they bought Celgene because they needed more cancer oncology, drugs. So they bought their pipeline. So anyway, that's something you need to take a look at. But I do want to read this, and this is actually just off of Wikipedia, but I thought it was interesting. And I usually look all over the place when I'm researching stocks. Eli Lilly and Company is an American pharmaceutical company headquartered, as I mentioned earlier, in Indianapolis, Indiana, with offices in 18 countries. Its products are sold in approximately 125 countries. The company was founded in 1876 by and after Colonel Eli Lilly, a pharmaceutical chemist and veteran of the American Civil War. Lilly's notable achievements include being the first company to mass produce the polio vaccine. I thought it was good history. I like history. So it's a cool company. It has a really cool history. Obviously, if you let's look at the max chart, because I'm actually really interested to see what Fidelity has in here for their max chart. So it might take a second to load. So yeah, wow, that's awesome, man. 1970. So here, this is actually only going back to 1970. But look at that thing, 1970. So $2.90, and now it's 147. But man, it just sat there and did nothing for 2 decades, and then had a nice little ramp up, nosedive, and then now it's doing this. So it's not the sexiest chart in the world at all. But based on the DGIF parameters, it fits really well, except the dividend growth. It's performed so well in the last 10 years. The question is, will it continue to do so? So take a look, do your own homework, and see if it's a good fit for you. Eli Lilly and Company, stock ticker LLY. All right, the 9th one, guys, that I want to cover today is Abbott Laboratories, and it's been around forever. This is not my favorite stock on the 20 by any means, but it is a good company. It's a good stock, and I want to give you some background on it. I think that's important. So just like AbbVie, this has a 47 years of dividend growth, and I'll explain why in a minute. ABT, Abbott Laboratories, stock ticker ABT, is another long-term performer, just under 10% on the 5-year dividend growth, sort of like Eli Lilly, but solid all around otherwise. It has over a 15% on the 10-year annualized return, so it's performed pretty well and above our minimum threshold. And it really has long-term stability. That's why it's on here. It's It's been a performer for a long time. The dividend is, relatively safe, and they're committed to increase it every year. So it is true kind of DGI, dividend aristocrat. Abbott Laboratories split into a pair of dividend aristocrats when it spun off AbbVie in 2013, remaining with Abbott Labs, where businesses are focused on generic drugs, medical devices, nutrition, diagnostic products, etc. Its offerings include some well-known consumer brands, so like infant formulas like Similac, you've heard of, Glucerna diabetes management shakes and bars, Pedialyte rehydration solutions. If I mispronounce anything, I apologize. But it's also involved with devices such as blood analyzers, Prodigy spinal cord stimulation, which is called SCS implants. And like BDX, Abbott has expanded by acquisition of late. In 2017, they bought medical device firm from St. Jude Medical and rapid testing technology business Alere, A-L-E-R-E. Abbott Labs roots go back to 1888. So this is very similar to the last one, Eli Lilly. I just think it's cool that these companies have been around since the 1800s. I think that's really, I think it's cool. I'm kind of a history nerd, so, whatever. And its dividend has been around since 1924. Like 1924. I mean, so, the dividend growth is 47 years, but they've had a dividend since 1924 in some capacity, according to what I found anyway. And I'll put a link down below if you want to take a look at the source. ABT has raised its dividend for 47 consecutive years, including a hefty 14.3% hike that went into effect in February of 2019. So that's one to take a look at, guys. I think it's an interesting company. I personally don't own it, and I may or may not buy this, but it had to be on the list just due to the history, the performance overall. Let's look at the max chart because I'm actually really curious. And then I got to go in a second because I have a trade actually. The market's closing in like 30 minutes. Look at, see, like some of this stuff concerns me, guys. I mean, I like to see it, but I mean, look at this stock. I mean, 20 cents. Is that even real? Imagine if you own that. Obviously it's a long time, but $89 now. But some of these charts, I mean, this thing is straight up, and it's saying a 43 PE ratio. So, I mean, is this value going to get cut in half? Is it going to be down to $40? I hope not. But yeah, just really interesting company, really interesting chart. In theory, it's a great looking chart. It's just, it kind of makes me hesitate when I see some of these charts that are going straight up. I mean, this looks like a Tesla 2-day chart, but take a look and see if it works for your portfolio. A lot of people love this because it is a dividend aristocrat, and they're committed to continuing to raise their dividend every year. So Abbott Laboratories, stock ticker ABT. All right, guys, number 10 on the top 10 ideas to check out. And then after this, I'm going to get into 10 bonus picks, so please do stay tuned. But number 10 is Stryker Corp, stock ticker SYK. And this one is a medical device company. It's been around for quite a while. I'm not sure if you've heard of this one before, but it has a 1.06% dividend yield. The PE ratio on it is also a little bit higher, sitting at right around 39.73. And the 9-year dividend growth, it has 9 years of dividend growth. The yield is kind of low at 1.09%. But it also has a very low payout ratio. The dividend payout ratio is only about 25%. And it has been one that has performed pretty well over a 10-year period. I'm going to pull up the 10-year chart. You can see this is a nicer looking chart than some that we've looked at earlier, where it just is kind of trending slow and steady upwards. It does have a little bit of a dip here, like a lot of stocks, in this whole time frame. But, this is what you want to see, not like the straight vertical lines up. So I do like this one. It's a large cap. It's $81.51 billion. They're located in Kalamazoo. And if you're not familiar with what Kalamazoo is, it's in Michigan. But it's a medical technology company. So this is healthcare equipment and supplies. Again, that's the industry within the sector of healthcare. And you can dig into it, but they've got a lot of different patents and a lot of different medical equipment. It's similar to Medtronic, but they specialize in different areas. And the growth stability on this is actually considered pretty low. So that's something to keep in mind. If you look at the 10-year, it's been good. So maybe it's a little bit overpriced here. I think it's one to put on your radar. I wouldn't necessarily buy it at these levels right now, but it is acting very bullish. The earnings per share have beat 4 cents, 1 cent, and 3 cents. So do your homework on it. It is a good long-term performer with a nice trending chart. Never exactly sure when to get into a stock. I always suggest a dollar cost average. I like to buy in fourths or fifths. So if, for example, you want $10,000 worth of a stock, you would buy 5 different times at $2,000 in dollar cost on different days, and use some technical analysis. You don't have to be a technical master to do this either. If you're with Fidelity, for example, so this is from 2/5, which is yesterday. Today is Thursday, February 6th. So this is from February 5th, 2020. And I'll just click on this. If you're not an expert on here, there's a couple of sites you can go to. You can go to tradingview.com, and they have great technical analysis on there for absolutely free. And if you're a Fidelity or any major broker should have something like this. Just take a look. This is saying limited rise. It's acting bullish. It's in a range. And their pivot point is 209. So this is saying that our preference, as long as 209 is support, so right now it's at 218, look for 228. Is it right every time? No, it's not right every time. If the whole market goes down tomorrow and this breaks trend, that whole theory is out the door. But this is just a guideline to look at, and it gives you a pivot point. So in Fidelity, this is saying, for example, what I would do, like if I wanted to buy this stock, is I'd put in an alert, and you can set it for a price target. So here it says the downside breakout of 209 would call for 203 and $200. Let's say I'm comfortable at buying this at $200. I might put in an alert at $201. And so I'll say, okay, 201, here's the different pivot point. It's probably not going to go much lower than 200 unless we have a huge market correction. So if I can get it, at $204 or less, that's pretty decent. It's a nice little pullback at $12. So I'm going to go in here and I'm going to set my alert, and I'm going to go ahead and click. Let me zoom in for you. Let me zoom in here. All right. So we're going to click drops below, and let's just put 204 for that. Let me expand this, and then note, I'm going to say buy, and then, look for 200 floor or whatever note, right? And then I'm going to collect, my different notifications, that I want. So all these different ones, and I'll just do complete setup. So there you go. So now I've got a price trigger set up, and if it drops below that price, it's going to light up my phone and my desktop and whatever, and I can go in and buy it. Or you can put in a limit order if you want. If you're not, not able, if you're going to be out of town, or if you're, your job doesn't really allow you to do it, you can put in a limit, just put in an order and put in a limit order of what you're comfortable with, put it in that range. If it gets there, it'll fill. But I don't really like doing that, because if the whole market just, has a huge correction tomorrow, it might go way lower than that $200, and then I'm buying stuff that I don't necessarily want. But take a look at this one. It's Stryker Corp, stock ticker SYK. All right, guys, burning some midnight oil here, but I wanted to kind of edit this back in and make sure I had it right for you. So you can see here's the top 10 that we just covered. I did have to manually add ABBV in, primarily, well, for 2 reasons. One, the dividend yield is over the metrics I was searching for, because it's at 5.4 or 5.45%, and we have a max on there usually of 3%. I think for Fidelity, it goes up to like 3.08 when you do the search. Secondly, the total return for the 10-year annualized, there isn't going to be a number for ABBV because of the 2013 spinoff with Abbott Laboratories. So that one is added back into this list manually. But you can see that all these fit the model really well. Let's look first at the 10-year annualized return. And you can see that United Healthcare crushes it. The 10-year return is 26.5%. And the dividend growth rate, the 5 years, also 23.5%. Just that stock just has crushed it over the last decade. And then going down the line, you've got LMAT next, and then the USPH, Lilly, Anthem, AMGN, Stryker, Abbott, Medtronic. All of those have done really well. In fact, if you look at the 10-year annualized return for the S&P 500, when you're starting at Abbott Laboratories at 15.49 and up, they've all outperformed. Medtronic is, probably pretty close in line to what the S&P has done over the last 10 years, depending on the exact date you use. But all these have performed really well. The only kind of exceptions that had to be made were on the dividend growth rate of 5 years. You can see at the bottom here, Eli Lilly and Abbott were both just under that 10% mark, but it was really close, around 8.5%. And everything else, was really strong with them, so I decided to include them. I'm going to zoom in, too, in case you're on a cell phone and want to see this a little better. You should have a nice view now of the 10, and I'm going to just scroll over so you can see the dividend yield, the 5-year dividend growth rate average, and then the 10-year annualized total return. So there's everything on your screen of the 10 stocks we just covered. Coming up, I'm actually going to cover 10 bonus picks, and the first couple on that list are two of my favorite stocks in the sector, so definitely watch that. The reason they're not on here is just simply they didn't fit the model perfectly. And I'm a little bit biased probably towards those stocks because I own them, so I tried to be as neutral as possible. Out of this list, before I made the video, the only stocks that I owned were United Healthcare and AbbVie. There's no way I wouldn't have included those in here. AbbVie is my largest holding in healthcare by a lot. It's not even close. United Healthcare, I've got a pretty good position in that, but I wish I had more. And I actually added a little bit of the USPH and the LMAT. So those two, I've actually added small positions to. It's a micro cap and a small cap into my portfolio because of the research from this video. I actually like those two so much. But everything on here is really solid. In terms of valuations and when to buy them, that's always a tough question. You need to do some homework, decide, if you think the market's going to go higher or lower. Dollar cost average is what I always recommend. But really, really great stocks, and I want you to stay tuned for the 10 bonus picks because, like I said, the first couple coming up, I actually own, and I really like those stocks. So stay tuned. Okay, guys, so now I'm going to get into 10 bonus picks. And as I mentioned at the beginning of the video, there's a lot of these picks actually in here that I own, but they don't necessarily fit the DGIF parameters. Healthcare is kind of a weird sector when it comes to that. Financials, there's a lot more picks that really fit into that model a lot better. And actually most industries, because in tech, you've got several different categories, especially in the semiconductors. But the first one bonus pick is CVS, and I actually own quite a bit of CVS. I like it, and I own a bunch of it, but the dividend growth isn't really where it needs to be for the metrics, of course. And, it's not that it's been bad. It just isn't quite where it needs to be. It comes down for me to the economic moat. With the Aetna acquisition, the dividend's just under 3%. I like the overall story and the future of that one. In the interest of time, I can't spend more than, a minute or so on each of these picks. So I'm going to move along. But CVS Health has a lot going for them. It, in my opinion, is priced attractively even here at $70. It's only increased 7.42% over the 52 weeks. So take a look at that one. The next one on the list, and this is actually one of my favorites right now, and it's on my top 20 for 2020 video. If you haven't seen that, take a look at it. I believe it's one of the only healthcare stocks on that top 20 for 2020. These guys acquired Celgene, and I've been a Celgene fan and bull for a long time through some good times and bad times with them. But, Bristol Myers actually just reported earnings and had really good earnings. It already had a big run, though, so it's only up 2.21% today. Well, I say only. That's pretty good. But it would be up a lot more. It's just that, it's performed very well. It's up 31% on the 52-week. It's got a solid yield, a 19 PA ratio. It's got excellent growth potential with the Celgene acquisition. Celgene has a lot of oncology and cancer type drugs. I was long on that one, without the acquisition. So for me, this is like getting Celgene with a dividend, which it's like, to me, it's like a dream. And this should be on the top 10. It's just the reason it wasn't is that the 5-year dividend growth is a little bit low. From my research, I showed at 4%. But the reason for that is they're using the money to make strategic acquisitions, and you can kind of argue the same thing with CVS. They're going through a big acquisition with Aetna. So, you got to be. That's why you got to be careful. You got to use logic sometimes too. So, just because it doesn't necessarily fit into a set 5 parameters, if there's a good reason for it, then consider that stock seriously. So, I actually own CVS and BMY, whereas on the top 10. I don't own Stryker. I don't own Lilly. There's a couple of them I don't own. So anyway, take a look at this one though. This is probably a top 3 out of the 20 I'm going to talk about. BMY is the stock ticker, Bristol Myers Squibb. And then the next one is going to be BDX, which is it's kind of the same trend, the low dividend growth in exchange for potential company growth with BDX, same kind of deal. While it's a massive player in the U.S., BDX increasingly expects its growth to be driven by markets outside the U.S., including China. Analysts expect Becton to generate average annual earnings of 11.2% for the next 3 to 5 years, according to S&P Global Market Intelligence. The annual dividend increases stretch back 48 years. So this is another aristocrat, a track record that should offer peace of mind to income investors. And the company has grown its payout by a total of 41% over the past 5 years, though that pace has slowed a bit more recently because of the mergers and acquisitions. Let's take a look at it. BDX, according to this, PE is high. I don't think that's accurate. You can see they had a massive drop today, 10%. So, obviously do some homework on that one. Take a look. BDX is the stock ticker. Could be a good entry point here. It might even go lower. Take a look at it. Figure out what's going on with BDX, Becton Dickinson and Company. And the next one that I want to talk about then is another one that I actually own and I've been buying. The reason I'm actually been buying this one is more of a potential short-term play. It's Gilead, stock ticker GILD. They're just above 10% on a 10-year annualized return. So their performance hasn't been stellar over a 10-year period. I'm going to open up the 10-year chart. But even though it's underperformed a little bit, it does have potential as a coronavirus play. That's an ugly chart. That's why it's not on the top 10. But it actually is, somewhat inexpensive, I think, here. Has a 4% dividend yield. It actually is one of the few stocks you're going to find, it seems like, that's negative almost 3% on a 52-week price performance, and that's after it went up 3% today. So I got lucky because I don't want to say lucky, but I've been buying this stock. I'm going to show you the 10-day chart. So they had earnings, and the earnings weren't great. And that chart's not great. But anyway, I'm in this in the lower 60s, so I'm actually up pretty good on it. It's made a little bit of a run. It's been kind of up and down because the earnings weren't really spectacular. But at the same time, China's saying they want to license this, or they want to basically be involved with Gilead Sciences to create a coronavirus treatment. So it's one of those that's getting boosted potentially artificially or short term, but take a look at it anyway. I do think there's some potential there, and that's why it's a bonus play. The next one, number 5 for bonus picks, is McKesson. It's a healthcare distributor. So MCK, healthcare distributors, it's solid, really low payout ratio. It's got a 0.08% yield. It actually went up 4% today. A lot of these are kind of running up here today for reasons we talked about earlier. Looks like they just got some price target boost here. Analyst Action, Goldman Sachs saying it's worth 173 versus 165, and that's probably part of the reason why it's jumped up a little bit here. It had earnings as well. Low payout ratio, could have easily made the list. Take a look at that one. Number 6 is one that a lot of people like. I used to own it for a long time, and I dumped it. It's Pfizer. I don't like their pipeline that much, but it is relatively inexpensive. It's starting to make somewhat of a comeback on the chart here. You can see price performance has been kind of a dog. It's negative 9.36%. The max payout ratio is over 50%, so it didn't fit the parameters there. It's about 55% on the dividend payout ratio. The yield is a little higher though. It's almost 4%. I'm just not as confident in the pipeline as I am with, say, Bristol Myers or an ABBV. So take a look at it though. PFE, one that pays a solid yield, and it could be a good fit for you. This one I mentioned a little bit earlier, but it's actually up big today. Cardinal Health, stock ticker CAH, at one point was up over 12% and is now sitting at 10.88% with 20 minutes left in the day. I got into this actually way back here in the 40s. So I was buying at 42. So I'm sitting at a 30% return or so. I think my yield on my cost basis is about 4.4%. So this is one of those value plays that I've made a career out of. What I'm good at is these dividend growth value plays, and I'm good at tech stocks, mostly in the cloud space. And those are where my bread and butter really lies. So this one is one I own, and I was up big on it today, and I'm still holding it. It helps my overall yield. It's a solid company. It has some risk because, of the nature of their business. It's a healthcare provider. It's located in Dublin, Ohio. And, with this one, it comes down to, some of the risks, it's pharmaceutical, and some of the risks come down to the opioids and legislation and things like that. But I actually like this one. It's one that, they've paid. So it doesn't make the list again because it's underperformed the market. If you look at the chart, it just hasn't done great. It's actually acting bearish until today. They had earnings and crushed it. But look at that chart. It's pretty ugly. So you can see why it hasn't been, a hot pick over the last 12 months and why I got it cheap. But I saw value in it. It didn't make the list because it's underperformed. I bought it when it was deeply undervalued. I started buying it back in like December 2018, and then was adding in the low 40s. It's got a less than 40% dividend payout ratio. It's got over 15 years of dividend growth. If you want a higher yield, this could be your huckleberry. Check out Cardinal Health, CAH. J&J is my 8th bonus pick, and it meets all the criteria except low dividend growth rate. This could be argued, but it does have 57 years of dividend growth. So it is a top performer. Easily could have made the list. I could have made an exception. I do own some of it. They've had a lot of issues with, lawsuits around, powders and all, the whole story with J&J. It meets all the criteria except low dividend growth rate, 57 years dividend growth. It's simply one I can't, not include in some capacity in this video just because it is really good and it's a solid company, even though it isn't a perfect fit to the model. The yield is about 2.5%, 2.47. Payout ratio is 42%. And the dividend growth's been steady. The roots stretch back to the 19th century. Another one of those old dogs, not a good word, but those old performers. It's been a great performer. It's well known. You probably know them for their brands like Band-Aid, Neosporin, Listerine, Clean and Clear, their baby products, Johnson baby products. It also, a lot of people don't know this, but it has a pharmaceuticals division, as well as a medical devices for surgery, which a lot of people don't know. In fact, I didn't actually know they had as much as they do until I started digging into the company. It's very diversified, well-rounded in the healthcare sector. Had some rough years due to lawsuits and litigation, as I mentioned earlier, but the dividend growth has remained steady at the 57 years, and the company has performed well over a 10-year annualized return, actually. So the analysts predict that it'll grow at approximately 6.9% annually over 3 to 5 years. So it's probably going to not going to knock it out of the park, but it could be a slow and steady, decent dividend payer. Take a look at it, J&J, and then number 9. Stock ticker is HUM, H-U-M, Humana. So let me just read this. Humana, low yield, under 1%, only 0.6%, but almost 15% on the 5-year dividend growth and around 23% on the 1-year annualized return. So it's right here. You can see 52 weeks at 20.23%. So it's done pretty well. I like this one, but the yield's low, and I just, overall, it wasn't one that I wanted to include. But there's people, the analysts are saying here 445 and it's 357. Who knows? It seems like it's relatively inexpensive. It's just the dividend's so low that I decided a lot of you wouldn't be interested in it, but I do think it's a good potential play for you if you're looking for some growth. Okay, guys, the last bonus pick, the 10th bonus pick, is National Healthcare Corp, stock ticker NHC. And it's a small cap. It's healthcare facilities, has a 2.5% yield. It's 2.45% yield today. It's got a 12.2% 10-year annualized return. So, not terrible performance. Around 9% on the 5-year dividend growth rate. And it could have easily made the list. There's nothing that really stood out. If I'm gonna buy something that has a 10-year annualized return of, only 12% when the S&P has performed at that or better, there's got to be a good reason. Either the yield's got to be really attractive, or there's got to be a growth story to it. This just didn't really have that. It's relatively fairly priced. It's a 2.5% yield, so slightly higher than you're going to get from the S&P 500. They're located in Tennessee. They've been around since 1971, so they're an established company. There's just not a ton of growth stability there. It's going to perform. It's going to give you a dividend, but I think there's probably better plays. But I did want to include it as a bonus pick because it's a small cap, and it's good to have a little bit of variety. So National Healthcare Corp is the 10th bonus play, and as you can see, this was a very hard list to make. Narrowing it down to 10 was basically impossible, and I did my best. I know the video is long. I appreciate you staying this long with me. Some of the best companies in healthcare don't really fit into the DGIF model. And it's important to, obviously I always say, do what's best for you, what's best for your portfolio, your suitability, your goals, your age, your risk tolerance, etc. All of these have potential, and it's really up to you. So I want you to, look at the 20 different picks. If there's 1 or 2, 3, whatever, if there's a couple that catch your eye, go do your own homework. Go take a look at their website, their financials, their leadership. See what, risk factors are out there. See what growth, potential they have, where there's some catalysts that might make them explode. Maybe I missed something. But, do your own homework and use these 20 stocks as ideas. All of them have potential to do, well, to either perform market pace or outperform the market. But of course, with anything, there's going to be risk. So a couple of these stocks might blow up good or bad. A couple of them might outperform and be up 30% a year. And a couple of these, could be red. There's no crystal ball. All you can do is do your homework, do your research, try to find companies that fit your risk tolerance, your portfolio style. For me, it's DGIF and trying to find companies that fit best into that model that I think are going to perform over the next 5-10 years. So I appreciate you again watching this video. If you haven't subscribed already, please hit the red subscribe button, bottom right corner. The other thing I want to encourage is I encourage you to smash the like button, because when I get likes, it helps other people find the video in the algorithm, the YouTube algorithm. So any kind of interaction, if you leave a comment, you hit the like button, that's going to help the performance of the video within the algorithm in YouTube, so that more people can find the video and gain the knowledge that you gain from watching this. Hopefully you learned something. So I appreciate your time. I appreciate your attention. I appreciate all the support that you've provided for me. I'm excited to make the next video. I'm not actually sure which sector I'm going to cover yet, but if you haven't subscribed, please do, because there's going to be 4 more videos and 40 more stock picks. Thanks for watching. Have a great rest of your day. Take care.